Passive Pockets is presented by Equity Trust. With all the uncertainty in the market right now, we're breaking down the state of multifamily capital markets, covering debt trends, transaction volume, and what's ahead for investors in 2025. How are deals getting done today, and why haven't we seen the wave of distress that so many predicted? Let's find out. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Jim Pfeiffer, along with my co-host, Paul Shannon. And today, we're joined by James Eng, a multifamily capital markets expert from Old Capital. He's going to help us make sense of what's happening in today's market. Let's get to it. All right, James, welcome to the show. Thanks for coming on.
Yeah, thanks for having me, guys.
All right, James, can you give us a quick overview of your background before we get going?
So born and raised in Houston, Texas, went to school in Austin at UT, did finance there, and then spent the last really 20 years in commercial real estate financing, 10 years at G Capital, and then the last 10 year at Old Capital. So I've done a little bit of everything in the space, and I've been mostly up here in Dallas. So it's been a good ride.
Excellent. So today we're going to talk about a lot of things. We're going to start out with multifamily capital markets. How have things changed since the Fed began cutting rates? And one of the things that came out recently, the Beige Book, which, it's the report by the Fed, as you know, that's released, I think, 8 times a year and basically summarizes economic conditions. This time when it came out, it broke a record, apparently, for saying the word uncertainty, right? It was in there 45 times. So that's where I want to start. How does uncertainty affect the capital markets and affect lenders? Are they still lending? Is uncertainty causing us issues?
When we look back at the last 2 years, when the Fed has just been raising interest rates sort of starting in 2022, right? So go back to 2022 summer, they started raising rates and then just went on a tear, right? So everybody sort of had in their model, 3% interest rates. And then all of a sudden they wake up, a year and a half later and it's 8%. And a lot of people, unfortunately, are still paying those rates right now on their bridge loans because it's SOFR still plus 3 or 3.5 on a lot of those bridge loans. When people are trying to get out of those bridge loans or even trying to do new deals, there's a lot of uncertainty. That uncertainty creates not only demand from the tenant side, they're a little bit uncertain of whether or not they're going to have a job in the next 6 months. And so they're not making that move to the new apartment. They're staying either at home or they're staying with a roommate. And so it sort of trickles down across the board, starting with the demand side on the apartment side, but then also from the investor side, in terms of when that uncertainty happens, everybody's a little bit more nervous. But what I would say in 23 and 24, really the only game in town on the lending side were the agencies. So your Fannie and Freddie loans, and those are stabilized loans, 90% occupied for the last 90 days. The property has to qualify, and then you can get those loans. And that's the only way you could really raise money because investors were sort of burned. You touch the stove one time, get burned to they didn't want to take a floating rate loan. At NMHC in Vegas here in January this year in 25, there was more bridge money coming out. And so even though people thought, hey, bridge is going to be dead forever. Nope, it's back. It's back that quick. So we're seeing bridge lenders get back into the space very quickly. So even though there's uncertainty, people feel like this is a good point of insertion for debt and then even equity right now.
There's kind of a strange phenomenon going on right now in the market, James. If we rewound 6 months, we were hoping to get more certainty when the Fed, were they going to cut interest rates or were they not? And we got that first cut in September, right? And typically when the federal funds rate drops, obviously it's tied to SOFR. SOFR is going to go down as well, but the 10-year usually goes down as well. And in this case, it started to rise, and it was really inversely related to what was happening with the federal funds rate. How did that period of time kind of impact lending, almost creating more uncertainty? And then you mentioned that bridge has kind of made a comeback. How is that phenomenon related to bridge being more popular now today?
Fannie and Freddie, they price off the 10-year treasury. When people, let's go back to September, October last year, 10-year was hovering, I want to say high threes, let's say 375. And a lot of refinances got done. So we locked a lot of loans in that space, 525 to 5.5. And so a lot of people got out of the bridges that they had, or if they had floating rate, they locked those in. The problem is once people sort of figured out that Trump was going to win and potentially he was going to throw on a lot of tariffs, which was correct, and that would spur inflation, then 10-year treasury started rising. And it rose, I want to say like up to 475 or something. And that pretty much put the brakes on any refinances, any new deals, probably from November all the way till, end of January. It was quiet. Like there wasn't a lot of new deals coming out. There wasn't a lot of refinances getting done. But, we've seen a pullback in the 10-year treasury closer to 425 now. And that's allowed a lot of people, like we just locked like 3 loans in the last couple of weeks, all around that 5.5 range. And almost that little bit of scare that this 10-year could run to 5 again, that showed people that it's not as straightforward to just, it's just going to keep going down forever. So when you do have a deal sort of on the table, let's lock it up. On agency stuff, you have a prepayment penalty, whether you do a 5, 7 or 10-year deal. That prepayment can be expensive if rates drop. And so some people are going towards bridge and they're doing, let's say it's SOFR plus 275 to 3 right now on good product. And so you could be hovering in that, 6 to 7% range. Most people are thinking a couple cuts this year. You could be in that sort of low 6s range. And then you can also buy an interest rate cap. And then you have a 1% prepay. And so some people are willing to take that risk and they're able to get a little bit more leveraged in agency. And so we're seeing that more on the A side, I would say. Not so much on the B and C side.
You mentioned rate caps and, we are talking about bridge debt. So rate caps seems like they've been fluctuating, as interest rates shift. And, every time that interest rates dip, everyone's like, oh, this is going to rescue all those deals that I have that have been struggling because of the rate cap prices. So can you talk about how rate caps have been more or less expensive compared, over the last couple of years? And for those deals, the current deals that are already on bridge debt, how are those rate caps trending? And is there's going to be some relief, or are we just still kind of waiting and hoping?
Most of the rate caps people are buying right now, at first they bought, 3-year rate caps, but on the initial term. And then now they're just buying like 6 months or 1-year rate caps. So they're comparing SOFR forecast for just a short period. Let's say you buy a 2% rate cap on SOFR's 4, you're really just paying 2% of the loan amount. And so you're just sort of prepaying your interest to some extent, but the lenders want that, right? They want to do that in order to secure your extension. So a lot of these bridge loans were 3 years plus 2 1-year extensions. And then in order to get the extension, you had to buy that rate cap. And so the cost really hasn't been as dramatic. I think people are used to it now. Before, you could have a $20 or $30 million deal and you could buy a 3-year rate cap and it was like $50,000. It was just like a closing cost. Like you didn't even notice it. But now, when it's 2, 3, 4% of the loan amount, all of a sudden, and then you're having to raise that as additional capital. And that's where it hurts more, is that it's not like you're doing a new deal and you know how much you need to raise for the rate cap and it's just part of the overall raise. It's more you're going back to LPs and saying, hey, we don't have this money. Like we've got 100,000 at the property level and we need $1 million. And that's a very difficult conversation to have right now.
Do you see any relief coming in the near future on those rate caps on current existing deals?
Not really, no. Because it's all in correlation to where SOFR actually is in the forecast for SOFR. So before, when SOFR had like a dramatic drop off in the forecast, so a lot of people used to think, all right, once the Fed cuts, that's going to go from 5 all the way down to 2. And so those longer term rate caps were cheaper. But right now the curve is pretty flat, right? Like people aren't expecting like a huge decline in the SOFR rate. So it's not going to get that much cheaper unless we get some sort of shock where all of a sudden people are thinking federal funds is going to 1 or something.
So of the transactions that you're, a new debt that you're originating today, James, is bridge and agency really the only show in town? What percentage would you say out of the total loan portfolio that you guys have seen over the last 6 months is agency versus bridge? And is there any other show in town like CMBS or Lifecos?
Most of the stuff we do is, I would say B and C multi, and most of those people are doing agency. So I would say probably 75, 80% of what we've done in the last 6 months has been agency. Only if a deal could not qualify. So if it was, 80, 85% occupied, did we have to do like a bank loan or a bridge loan on it? But you better be getting a deal, right now on the property purchase in order to do a bridge loan because it's costly, right? You got to buy a 3-year interest rate cap and the overall cost is higher for a bridge loan. So you just got to have to work that into your numbers.
What about borrower requirements, just qualifications of the borrower? Has that changed any over the last, let's call it year or so, where lenders are requiring more reserves or more experience or personal guarantees, whatever it might be? Is there more strict qualifications for the borrowers?
I'm sure you guys have read like Howard Marks and stuff, but he gives a great analogy of sort of the race to the bottom. Let's say you have 20 bridge lenders and everybody's competing for the same deal. You know, at first, everybody comes in at 60% leverage and 4% over SOFR. And then there's 10 guys left and then it's 80% and SOFR plus 3. You know, at the very end of it, they say, well, actually our borrower has bankruptcy and they got foreclosed one time and no problem. 2 guys will do the deal. Right. And so deals got done in 21 and 22 at those levels. But now, you submit a deal to even just Fannie and Freddie, the amount of scrutiny that you're getting is very high. They are digging into every PFS, every schedule of real estate, every property you own. They're driving properties that you own. They're asking for T12s of properties that you own. And they're making sure that, every tenant is in their unit. Like, I don't know if I make this up, but, on one deal, it was a smaller deal and, agency needs to be 90% occupied. They almost had to take a picture of the tenant with their furniture in the unit. Like the tenant had to be in the picture and they're looking at every lease, reviewing every lease, tying it to the rent roll. I mean, it's the amount of due diligence has increased significantly. And what happens is they've had some issues where borrowers basically, let's say they told Fannie Mae, hey, we're buying this deal for $50 million. But in reality, they were buying for 25 and they got a loan for 25 from Fannie Mae. So 100% financed or more by making up everything. Fake PSAs, fake income statements, fake everything. Fannie Mae now has, it's not $1 billion, but I think it was like $750 million of loans that they don't know if they're going to get paid back on because, it's just way over leveraged. And so when deals are going, just flipping like hotcakes, like nobody remembers. But now when, the market pulls back 20, 25%, now all of a sudden people have an issue, lenders have an issue, especially on stuff like that. The pendulum just swung way over in terms of due diligence.
You're talking about the loans now, the lenders are being more critical in their evaluations, right? So as an LP, a limited partner, right, that's what our community is. We're often focused on returns, but debt structure, as we've seen, makes or breaks these investments, right? What key questions should LPs be asking about the debt that's being originated today? How does it impact their returns? And a side question, and I know it's too many questions to ask in one, but should LPs have a little bit more confidence in deals now because lenders are really digging in and doing so much more due diligence? Should they rely on them a little bit?
What drives me crazy is obviously I'm close to the lending side, so that's like close to my heart. But when I look at a deck, I'll get a 60-page deck. There will literally be like half a slide on the debt. And I'm like, why do I have 25 pages on DFW? Like, I get it. A lot of people are moving to DFW, but like, I don't need 25 pages on DFW. I have like a top 10 list of stuff that you should look at as an LP. And I put debt as number 2, maybe behind sponsor. So if you have sponsor and debt, and I put those like on the foundation because right now, I mean, a friend of mine just got an email and the sponsor is fantastic and it still got foreclosed because of the market and the debt. So sponsor and debt go right next to each other on the foundation of looking at these deals. Depending on how comfortable you are with the sponsor, I would get very comfortable on the debt. My preference is agency fixed rate. Second is agency floating.
Why do you prefer those as an LP?
As an LP, when I invest in a deal, my range of outcomes is really, I'm just going to use equity multiple because it's easier math. My range of outcomes is really 1.5 to 2.5 in equity multiple. Maybe I've seen one deal out of the last 10 years where the LP got 3x. So as an LP, my upside is sort of limited. If this thing's a home run, I get a 2.3. If it's not a home run, I get a 1.7. It's not like venture capital where it's like 0 or 100x. Like as an LP, your upside is limited to some extent. So I want to take the most conservative approach on these deals. So agency loans are 5, 7, 10, 12-year loans, typically. They are sized on in-place income. They do look at pro forma expenses, but they look at in-place income, and that's how they size it. So a lot of deals in 21 and 22, if you did agency loans, you were 60% or 50% levered. Even people who did those loans, when they came to, 2024, 25, yeah, the value's down 20%, 30%, but they still have equity in those deals and they have time to ride it out. So that is the big thing. Howard Marks has this saying that, 6-foot man was trying to cross the river that was sort of 5 foot deep on average. So on average is fine, right? In some markets, you're going to be fine. But when it gets too deep in the middle of that river, like right now it's deep. I want enough time because that seems to hit people the worst in this business is like, if you got a fixed rate from 2018, like you're not calling me right now. It's all the guys just in the last 3 years on floating, 70, 80% levered on bridge who have maturities. Those are all the calls I get.
It's clear, right? If you look at LPs and where they've lost money, debt has been the issue, right? And so I think it's interesting then that all these pitch decks we're still getting, like you say, have a paragraph maybe on the debt. And as you said, 10 pages on the DFW market where we'd like that reversed. And it's funny that you say that and, like light bulbs are going off in my head. Yet, of course, but still it's not translating, right? So I think that's a really powerful thing for LPs to start looking at is the debt has to be the second most important thing because the things that lost you money recently were the debt and the operator. So those are 1, 2 in my book.
Yeah, for sure. Let me go back to answer your question. What can you do as an LP? Because this is frustrating to me as well. You can ask for an update on where you are in the process. Let me take you through the deal timeline. Let's say somebody gets under contract. They have a loan application that they're going to sign, either Fannie, Freddie, Bridge, whatever they're going to do. But those terms are not approved until probably about 45 days in after the PSA is signed. And so they usually have to start raising money before the debt is finalized. And so what I would do as an LP, if you're concerned about the debt, which I am, is ask for the term sheet on the deal, or loan application on the deal, or at least pull out the top, first 3 pages that show the terms of the deal. Then you know who the lender is, what the terms are, what the maturity is. Because on a lot of these decks, I've seen it where it's like they just put the loan term and they just put 5 years, but it's not 5 years. It's a 3-year initial term plus 2 1-year extensions that's based on a debt yield hurdle or debt service coverage hurdle to get there. So when you just say 5 years, that's not correct, right? Because you have to qualify for those hurdles. So when you see that actual loan application, that's going to detail all that out. So it asks for the loan application if you can. And then if someone is doing an agency loan, about 45 days after the PSA is signed, they will lock the rate. When they lock the rate, they have to put 2% of the loan amount down. If they don't close, they lose that money. And so to me, at that point, once I know the interest rate is locked on an agency loan, that gives me a very high certainty that that deal is going to close. And then you know exactly the interest rate because as you said, there's a lot of uncertainty in the market and, they could put on the sheet, yep, 525 interest rate, asterisk, right? Because it's pending. But then if interest rates run 50 basis points, all of a sudden it goes 525 to 575, you've got a different deal.
Yeah, this is such an important conversation for LPs. If you think about it, the lender's bringing 50 to maybe 80% of the proceeds, depending on the deal. They're the biggest player in the deal. They're also the last money in and the first money out. So it's not the LP that takes the biggest position. It's not skin in the game from the sponsor. Knowing what the debt terms are so critical to the success and profile of the deal. And I love how you kind of evaluate the risk, James. I've never thought of it that way, where the standard deviation is between like a 1.7 and a 2.3 equity multiple. You're not going to knock it out of the park. Why not take a little bit lower return to get much more security? Why just swing for the fences when you could get on base multiple times? So I think that's where a lot of people got ahead of their skis and have gotten in trouble. But we really haven't seen the wave of distress in a lot of these deals that maybe do have low DSCR coverage ratios, or, the bridge loans that didn't hit their debt yields. Why haven't we seen that yet? I know there was an era where we kind of extending and pretending with these loans and lenders were willing to give special terms to borrowers, but is that coming to an end? And how does the landscape look today?
I was trying to explain this to somebody, and if you go back to 21 and 22, let's say there's 20 different bridge lenders. One guy might offer the best terms, lowest interest rate, highest LTV, most favorable for the sponsor. But then there's 20 different guys. And so now when you look at, the bridge loans maturing this year in DFW, you've got 20 different lenders, and they're all different debt funds. They all have different asset management teams, different specialties. And so what we've seen is a hodgepodge of some people who have come in. They've just said, look, you haven't paid me in 2 months. I'm foreclosing. They foreclose and then they sell it. Literally, like there was a deal like 10 minutes from my house, got foreclosed. The lender started getting emails from all these GPs. They had 12 offers in like 2 days because of the location. And then they sold it in less than 30 days. Closed. Done. It was so fast. Like it didn't go through a process. Didn't have, 3 weeks of tours, 4 weeks of tours. Each deal is so unique right now. Another deal, a broker sent it out this week and he said, look, call for offers is next week. It's like, what? Where's the financials? Well, we don't have any financials. You got to go over here to get the financials. They're trying to avoid the foreclosure on the record. So a lot of these guys have negotiated the first extension, got the first extension. Okay. Bought the interest rate cap, paid the extension fee. No big deal. So that took them from 24 to 25. Now we're looking at 12 months left on that loan. And now the lender is saying, well, I appreciate it. Pay the extension fee, buy the interest rate cap, but we're also going to need a $3 million pay down on your $20 million loan. It's like, ooh, I had $300,000 teed up ready to go, but I don't have $3 million. And so now when we talk to brokers in the first 3 months of 2025, they've done more BOVs than they ever have. Nobody knows the value of some of these properties.
What does that mean, BOV? Sorry to interrupt.
Broker opinion of value. So before a broker goes out to sell a deal, the seller might go and get 5 brokers' opinion of value. And so all these brokers are running around. Everybody wants to know their value because there hasn't been a lot of transactions the last 2 years. The lender wants to know the value. The LPs want to know the value. All these people want to know the value. And so a lot of stuff has been hitting the market right now. And I don't know if it's all going to trade, but a lot of it's going to be, if you bought it in 21, 22, it's going to be essentially at the debt amount. Some of that stuff is not going to trade because it's not worth the debt. And so the lender is going to have to make a decision. Do I foreclose on this asset, or do I bring in a new GP and give them favorable terms? So that's what we've seen as well, is you don't see the foreclosure on the real deal. All you see is they switched out the GP. The new GP gets a new 3-year bridge loan, and they're giving it to them at 80% or higher, 90% leverage. And so imagine you buying a $30 million deal and all you have to do is come up with $2 million because they're giving you a $28 million loan. So we've seen that a couple times. So there's distress, but it's sort of hidden behind all these different iterations of deal types out there.
You said it, like deals aren't necessarily happening maybe not even at the pace many expected this year. And, buyers and sellers maybe are stuck in a standoff, right? Where prices aren't matching. So are we waiting on more Fed cuts, cap rate adjustments? What needs to happen for transaction volume to pick up?
The federal funds rate cuts, I think, will help as long as it's not a deterioration in the economy. Like if it's a slight, 25 basis points in May, 25 basis points in December, and inflation sort of under control, I think the Fed cuts will help. The bigger thing is 10-year Treasury. So when 10-year Treasury gets down to under 4 and you can get debt at around 5, low 5s, a lot more stuff starts to move. And the reason is, in 21 and 22, essentially cap rates were on top of each other, right? So it was, Class A deal was 4%, Class B was 425, Class C was 450 cap rates. And now those have expanded, all those have expanded out. So an A deal is at 5, a B deal is at 6, a C deal is at 7, let's say, for example. So there's a 100 basis point spread between all three. If you want positive leverage, I did a post on, what's the first thing that you look at as an LP? And everybody's like, I want positive leverage. So cap rates are higher than my interest rate. And so to get positive leverage, you need an interest rate at 5 or below to buy a Class A deal right now. Most Class A deals are still at neutral leverage. B deals, I would say, are at a slight positive leverage. So most of those deals are going off at 575 to 6. If interest rates are at 6, then all the B deals can't happen. And the C deals, they're happening right now, but they're happening on smaller deals. So 10 million and under. So a lot of the bridge money in 21 and 22, they wanted bigger deals. So $7 million loan wasn't getting a lot of attention. But if you brought me a $40 million Class C deal, you got all the attention in the world because it was a big enough deal. And so a lot of those deals are in trouble. Like we just saw a 400 plus unit deal here in Fort Worth. We got a huge bridge loan because of the competition. And now they're trying to take it to market before foreclosure.
For context, James, are the cap rates that you're mentioning and the examples, is that really DFW focused or is that more national?
I feel like DFW is like the epicenter. Maybe that's because there's a lot. Yeah, I just use DFW. I think for secondary markets, I would add 25 basis points, 50 basis points. But now that capital moves so freely, like there's nuances even within Texas, but it's not that much, right? So like maybe you get 25 basis points a little bit higher in like a Houston or San Antonio, just because, there's a little bit more industry concentration. There's a little bit more insurance risk in Houston. San Antonio is a smaller market. So you get a little bit more, but now that capital moves so freely that pretty much if there's a place in the US, especially that has, the job growth, population growth, like that capital is going to go there. But yeah, those cap rates were DFW specific.
I'm not exactly sure how to phrase this question, but I was listening to a podcast today and one of the guys was like, well, interest rates are so high right now. And my thought was, yes, they're high relative to recent years, but they're not high relative to historical norms, right? And you mentioned we need positive leverage so that, the cap rates and interest rates. So do we need interest rates to move or do we need cap rates to move? And is it possible that, we're just going to be at kind of a middle ground where interest rates maybe don't move a whole lot, but maybe cap rates adjust to this new, I hate to say it, but the new normal? I mean, can you talk a little bit about that? Because we're all just waiting for interest rates, but is there another factor here that could help us out?
Yeah, I mean, I think you have to think about it from the seller's perspective. So if a seller bought a deal in 2018 and, they're sitting there on an agency loan that's fixed rate and they've got 3 more years, there's no reason for them to go right now. So they don't have to go. And so that's why we've seen transaction volume that's down. It's probably 30% of the peak in DFW, right? It's only the people who have to go right now that have to trade. And so those are the deals that we're seeing. Those are the only transactions that you're able to see this cap rate piece. There usually is a 150 basis point spread between the cap rate that you're buying at and the debt that you're using on your loan. And right now it's 0. And for the last 2 years, it's been 0 in terms of that spread. You can say that you want 150 basis points, but you might be sitting there for another 2 years, not investing in anything. So that's the trade-off. I mean, the people who are buying right now, they are essentially betting more so on rent growth, right? So if you look at the amount of supply that's hitting in DFW, Austin, San Antonio, all the Sunbelt markets, you're seeing rent growth is flat to negative right now. And so these people are betting that if they come in and buy right now, that they will be able to get outsized rent growth. I would say higher than 3%. I don't know what they're underwriting exactly, but probably 4 to 5% in years 2, 3, potentially 4 of their forecast. And that's the only way to really make it work on a lot of these deals to get to your return.
So James, you mentioned earlier in the conversation that if we get a couple rate cuts this year that are modest, 25 basis points here or there, and it's not related to what I think you were alluding to, a recession or a downturn in the economy, things could work out. We might get that rent growth. We might get that spread to come back between what borrowers are paying on their interest versus the cap rate that they're coming in at. What if we do get a recession? What are some of the risks? I guess what I'm asking is, are lenders concerned about policy risk? Obviously, we just got a new administration coming in. Tariffs are being threatened and enacted, and that could impact construction materials. It could impact the economy. So how are lenders considering those factors when they originate new debt?
I would see those maybe playing out a little bit more on the development side. Most of our guys are buying in-place deals, so we're not doing a ton of development in terms of cost. But it is still hard to go to a bank and get a development loan because of the cost, because of the rents you have to pro forma, the amount of equity you have to put down. And so very few people are developing right now. I mean, if you listen to REIT calls, I mean, these are huge REITs that they have $1 billion sitting on their balance sheet and they're still not building, right? They're doing like 3 deals or 4 deals in total for the entire year. So your normal, merchant builder, they're most likely not going to go to their local bank and build a, 200 unit garden style deal up in North Dallas. And so I think on that front, it's still very difficult for new supply to come into the market. I think nobody knows how to underwrite that really, in terms of, if the tariffs come, I would say that the immigration piece, whether it's in San Antonio, whether it's in even some submarkets in Dallas, if all of a sudden, the ICE comes in and picks up 30 residents, and your occupancy drops from 90 to 70, overnight, that's a problem. That's going to impact some demographics and tenant bases differently. And so I think when you're looking at deals as an investor, I would sort of figure out the tenant demographic and, that submarket. The reason you do multifamily, the reason I like multifamily and I've invested in multifamily is the diversification of the tenant base. So if all the tenant base looks the same, everyone's a landscaper, everyone's in construction, I would try to diversify that a little bit.
Excellent. Well, thank you, James. This has been fantastic. You've given us fantastic, wonderful information. If people want to follow you or connect with you, what's the best way to do that?
I'm on LinkedIn. I'm on YouTube. I try to put out like a video a month or so. And then you can follow me at Old Capital Podcasts. We do our own podcast that we've done for a while, and people can reach me there.
Hey, big shout out for the Old Capital Podcast, James. I'm an avid listener and always pick up good details every episode. So thank you for that.
I appreciate you listening.
All right. Thanks, James. We appreciate you being on.
All right. Thanks, guys.
That wraps up our market update on multifamily capital markets. A big thank you to James Eng for sharing his insights on lending, deal flow, and what LPs should be watching for in 2025. If you found this episode valuable, don't forget to like, subscribe, and share your thoughts in the comments. For more passive investing insights, visit passivepockets.com and join our 7-day free trial. Thanks for tuning in, and as always, happy investing.